Good day everyone, my name is Althea Louise Laylo, together with my team Ms. Szyra, Allana, Cailipan, and Miss Princess Nicole Lizardo, and we are here today to discuss to you our topic, Developing Credit Guidelines. Let us first define what is a credit guideline. A credit guideline is a documented set of guidelines that establish the methods, terms, and repayments of customer credit and include provisions for collections if the debt is unpaid. A credit guideline contains a policy that structures the amount of credit that is granted to the customer, as well as how collections are to be conducted for delinquent accounts. The guideline is an essential element of the finances of a business since it impacts the amount of working capital required to support the accounts receivable, and also it influences the amount of bad debt losses. So let us now talk about the importance of a credit guideline. Operating your business with an invoice-based invoicing model without credit guideline is obviously dangerous. The reason behind this is that businesses without credit guidelines have fewer contractual methods in obliging their customer to make payments on time, and timely payments cause reduced cash flow. Less cash flow increases the difficulty of paying bills and maintaining successful businesses. If you eventually decide to send customers' debts to collection or file a lawsuit, these regulations make it difficult for your clients to make a case against paying back their debts. And with that, your clients can now understand that you won't tolerate unpaid work by your organization by just learning your credit guidelines. Due to the fact that credit guidelines let customers pay big debts in manageable installments, they also reduce the chance of outstanding debts. These installments simplify clients' payments, and because they improve your cash flow, they simplify your life too. In other words, credit guidelines benefits both you and your client. So you might be wondering what should be included in a credit guideline. Let us talk about that. First is the client qualification for receiving credit. It's best to run credit checks on your client before you offer them credit, though you can only do so with your client's permission. Your credit guideline should thus state what a client's credit report must look like for the clients to qualify for credit, and clients with poor borrowing history should be disqualified. Second is the credit limit. If you expect several customers to take credit from your company, figure out how your maximum credit limit can accommodate several borrowers while keeping your cash flow adequate. You should include interest rates in your credit guidelines alongside with the payment deadlines, acceptable payment methods such as credit card and personal checks, early payment discounts, and late payment fees. Fourth is the request for customer information. In your credit guideline, state which type of information you'll need clients to provide in order to approve them for credit. Such information could include how long they have been in business, the services they expect to need, and their credit score. And last but not the least is the debt collection terms. No credit guideline can entirely prevent some debtors from failing to pay what they owe you. That's why your credit guideline should describe the actions you'll take in the event of an unpaid account. Such action could include sending the debt to collections or suing the client in small claims court. So after giving you a background of the basics in credit guideline, let us now proceed to our main topic. Our first topic is the initiating and maintaining credit file. So what is a credit file? A credit file is the collection of data about an individual's borrowing and repayment history. So a credit company should create a credit file for each customer that has an open sale on the account or that will be sold on an open account in the near future. The file should be labeled with the client's basic identification, and the minimum data should be: first is the customer sold to name and address, second is the customer account number, third is the name of contact at this location, fourth is their telephone number, and lastly, space for credit guides if not available at that time. After organizing this basic data needed to create a credit file for your client, the other data needed may be added on a later date. The other data that I am talking about are the tax codes, credit ratings, date customer added to file, and customer status codes. As the folders are complete, file them alphabetically by customer's name. Place statements, trade reports, account status correspondence, collection letters, and any other data that is pertinent to the open credit account. Some care should be taken to eliminate any paper from the file that is not directly related to the customer's credit history. Arranging and stacking files and folders in a well-classified manner eliminates every chance of any document getting misplaced. And anything that is not related to the customer's credit history must be removed from the file to lessen the unnecessary clutter and avoid confusions on the other data that are updated already. The next topic will be setting credit guidelines. After weighing out the pros and cons of extending credit to customers, you will now need to figure out how much credit to offer. And this is not something to gamble on. Setting appropriate credit limit is important to ensure that you can give what the customer need, but also protecting the companies against the financial instability. The basic and very quick way to establish a credit line is by calculating 10% of your net worth.
My name is Nicole and Lizardo, and I'm here to talk about the credit line matrix or the credit line or the credit limit. Credit line matrix. This is another way or approach to which can measure the customer's ability to pay, either based on their financial strengths that is reported to the rating services or company, and their composite credit appraisal developed through their history files. Dun and Bradstreet. What is Dun and Bradstreet? A Dun and Bradstreet rating is an all-encompassing assessment of a company's financial strength and creditworthiness in the marketplace. The rating is predicted on data contained in the company's financial statements that were submitted to Dun and Bradstreet. There's information in there about a company's past payments, its standing in the industry, and its financial health. These ratings are divided into two parts: the rating classification and the rating composite credit appraisal. Dun and Bradstreet classification. A company's net worth or equity position is used to assign a rating, which reflects the firm's financial strength. At a glance, we couldn't know what does the combination of letters and numbers they are, but they hold a significance in rating a company's credit line, thus creating a credit line matrix. As we can see, in the rating scales, 5A is being the highest rate, which also means that the 10% net worth of the company is the $50 million and over, wherein the lowest rating is HH, representing the company's net worth is less than $5,000. Moving forward, Dun and Bradstreet credit appraisal. The Dun and Bradstreet rating system composite credit appraisal component represents a company's overall creditworthiness. This score is calculated using a company's payment history, years in business, public documents, employee count, and financial data. It has a scale of 1 to 4. A score of 1 indicates that the company is the most creditworthy, and being the 4 is the opposite of 1. Dun and Bradstreet rating scale, the composite credit appraisal. We can see in the scale, if a company have the 1 rating with the rating classification, it just means that their net worth is low risk with high credit. They are most likely to be able to pay on or before their due of the loan or the credit. there are more complex methods of determining credit lines that necessitate the use of electronic data processing. One way is to assign positive and negative numbers to different important ratios, down from a firm's financial statements. The values were allocated to specify facts, such as the percentage of volume purchased from the company, pay habits, years in business, pre-tax profit or loss margin, and other criteria that will be simplified and described by Ms. Cailipan in the latter section of the report. Moving forward, presented here are the some variables that can create a company's financial statement or strength, which are the ways or the variables to determine a company's credit line matrix. One is every credit line begins with the customer's tangible net worth. For the very first is already mentioned by Ms. Laylo earlier, which is the usual starting point of 10% of the tangible net worth, also known as the credit card. For the example, if the INS company's net worth is $100,000, the 10% of it is equivalent to $10,000, which is the company's credit line or the credit guide. The 10% dollars will rated according to the Dun and Bradstreet as FF, as it falls under that rating. Number 3 is the percentage of cost of goods furnished. The percentage of cost of goods furnished is another variable to be rated and to be included in a firm's credit line matrix. When a percentage taken is under 25%, the contribution of it in the credit line matrix is 0 or none. But when it is ranged to 26% up to the 50%, there is an additional of positive 5% of net worth. And when it is higher than 50%, of course, as we can see, it is a positive 10% of the net worth. Number 3 is the paying habits of customer is assigned certain factors such as number 1 is discounting, 2 is prompt, 3 is the net terms, 4 is slow, 1 to 10, that is rated from 1 to 10, and number 5 is slow, 11 to 30. The additional rate for the company's credit line is based on the factors as I mentioned earlier, respectively. If they pay on a discounted term, it contributes a positive 10% of net worth, and as for the rest, respectively. Any factor or rates may be assigned to any of codes which can be determined by credit management. Number 4 is years in business. In this part, it rates how long the firm or the company is running. New company businesses that is only running for 3 years and under are much likely to get any good ratings, and thus the contribution is at 0. Business that is in the industry for 3 to 10 years already would get an additional of positive 2.5% of their contribution, and for the businesses that are over 11 years have the positive 5% of net worth. Next is the profit margin. If the profit margin is available, a new rate may be applied to each 1% margin or loss. For example, the 10% of the net worth assigned for each 1% of pre-tax profit margin. A profit margin of 4.2% contributes a 0.84% of net worth to the credit line. And now on the 6th item, halfway of the 12 ways, is the current ratio. The current ratio and other formula that I'll be mentioning will be discussed on the latter part, as I've said earlier. So going back, if the ratio computed is on 0.2 and over, this contributes positive 10% of net worth in the credit line and goes on according to what is shown or what is in the book. On to the 7th item, the liquidity or the quick ratio. For the liquidity or quick ratio, when the ratio is over 2 points, it contributes an additional positive 15% of net worth in credit line. If it falls under 1 to the range of 1.99, it contributes a positive 10% of net worth, but if it falls to 0.80 to 0.99, it is equal to the positive 5% of the net worth contribution, and as it follows. Number 8 is the ratio of current liabilities to inventory. For the calculation of ratio of current liabilities to inventory, it determines the relationship of trade payables to inventory, as if it weighs less than 0.65, it contributes an additional credit line which is worth 10% of the net worth. 0.066 and 0.99 with no additional contribution, and 1 and over is by negative 5% of the net worth. Number 9 is the ratio of inventory to net working capital. This is the ratio and the contribution it weighs for these variables. 0.50 to 0.99 for a positive 5% of the net worth contribution. None or 0 for 0.25 to 0.49. And a negative 5% of net worth if it falls lower than 0.25 and higher than 0.99. Number 10 is the total tangible net worth. For this variable, all assets excluding goodwill and decreasing the liabilities and the subordinate debt is divided by all the subsumed debt provides the ratio to determine the customer's investments over his borrowing, and it may weigh as the following. 10% of net worth contributes to the credit line if the ratio is 2 and higher. On the middle part, 1 to the range of 1.99 is another positive 5% of the net worth, and if it falls below 1, it is equivalent to the negative 5% of the worth contribution. Number 11 is the days sales outstanding, or the DSO. The maximum DSO can be determined as 30 days plus selling terms as a baseline against which the computed DSO can be assessed. Each day when the permissible DSO exceeds the calculated amount, a weight of 0.10% of net worth can be applied. And we are here at the last, number 12, the ratio to measure the rate of the turnover of inventory. This may be the last in the variables, but there are still a lot of variables to be considered and added in the credit line matrix. So moving forward, the excessively high or low turnover ratio is considered to be questionable, and its weights may be assigned what is presented. 10 to 30 is equivalent to a positive 10% of net worth, a positive 5% of net worth for the range of 5 to 9.99, and if it's less than 5 or more than the 30, it is equal to none or 0. The calculation of ratios are nothing more than the reduction on mathematical terms of the relationship between critical items as reported on financial statements. They are one of the key factors to identify or to rate or to create a firm's credit line or the credit line matrix. So, an additional information, if there is an O, this means that there is no information given by the customers. The next part of our topic are the list of key ratios that are used to establish to understand the customer's or company's financial strength. The 12 keys ratios or the 12 variables are just some of the ways to have the customers or company's credit line matrix, and there are some other more ratios or variables that will be mentioning Ms. Cailipan next.
After showing the suggested ratio variables based on the book, these are the other key ratios that are used to establish and to further to understand the customers and company's financial strength. First is net profit over net sales. This ratio is calculated by dividing after-tax profit by the net sales. It is assessed as the operation efficiency, and when compared to industry trends, depicts the appropriateness of earnings to sales. Second is net profit over net worth. Divide net profit of the company by net worth. Net worth is determined by subtracting total liabilities from the total asset. While this ratio will measure operational efficiency, caution should be exercised in high-debt situation because favorable earnings on net worth may imply trading on equity and the high debt may become burdensome. What is most important here is that analysts must consider the industry factor to assure that the company's ratio is within the guidelines. Third, net sales over net worth. This factor is calculated by dividing the company's net sales, total sales less returns, allowances, and any intercompany transactions by the net worth. This idea assesses the proportional return on invested capital. A high turnover shows that the company is overtrading and leveraging vendor credit to finance sales despite the file owner's low involvement. When compared to industry average, this measure becomes more important. Fourth, net sales over working capital. This ratio is derived by dividing the net sales by working capital, current asset minus current liabilities. The factor is known as a working capital turnover, and it is used to measure the adequacy of working capital to support the operations by determining its turnover. This factor is another indicator of whether a company is overtrading or processing too much volume of the amount of available working capital. This figure is especially significant when it is very large or close to exceed the high quartile of industry standards. When the ratio is exceeding high and overtrading is suspected, the company's short-term finance should be carefully evaluated. This situation would be shown on the balance sheet as short-term bank loans, advances from related sources, and other available finance. Fifth, cash flow potential. This analysis is not a ratio, but is calculated by adding annual depreciation to earnings. Then by subtracting the current portion of the long-term debt, the difference measures the ability of the firm to meet annual payback of long-term debt without depleting working capital. The next one is fixed asset over net worth. Divide the company's fixed asset by its net worth. The result is that proportion of the net worth invested in fixed asset. Usually, the ratio should be less than 100%. If it reaches 100%, it is usually assumed that the creditor's money is being utilized to finance the investment in fixed asset. Fixed asset to net worth ratio vary as much as the industries themselves. The estimated results become more meaningful when compared to specific industry mean or average ratio. In any case, it displays that the portion of the net worth invested in fixed asset, which is money that cannot be used to support current operations. Next is total debt over net worth. This ratio calculated by dividing the total debt by net worth. It is used as a measurement of creditor protection by indicating the amount of net worth that is absorbed by the current and other debt. As the ratio arises, the trade creditor's protection becomes less available. It shows the link between the total creditor's interest and the owner's investment. As the percentage approaches 100%, the net worth becomes insufficient to absorb any asset shrinkage. Next is current debt over net worth. Current debt divided the net worth indicates the relationship between the creditor's current funds and owner's investment. The higher the ratio, the less accessible for short-term creditors. This should be compared to industry criteria to establish net worth efficacy and what is considered normal exposure. Current debt over working capital. The ratio is calculated by dividing the current debt, including the current portion of the long-term debt, by the company's working capital. If the ratio appears too high, nearing 100%, or too high in comparison to industry average, the company lacks operating capital to pay existing obligation. A high percentage indicates overtrading, which is perhaps one of the riskier sorts of consumer. Any abrupt change in market conditions will result in instant loss of revenue to pay creditors. The possibility of collecting the receivables is further lowered by the fact that the large debt is very certainly secured by the exact present asset from which collection is required. Next is current ratio, the most common ratio used and calculated by dividing current asset by current liabilities. This ratio offers a general indicator of the ability of the firm to meet its current obligations. A ratio, for example, means that the company has $2 in assets for every $1 in liabilities. Because current assets are those that become available in normal business transaction to pay current liabilities. The higher the ratio, the better. This figure becomes even more meaningful when compared to industry average because the composition of current asset itself can make up a huge difference in the availability of cash to trade creditors. A current asset with a large component of inventory dollars is not as appealing as one with more cash or receivables and a small inventory. Next is liquid quick ratio. This ratio indicates the protection afforded short-term creditors in cash or near cash assets. It is computed by dividing all liquid current assets, excluding inventory, by current liabilities. This ratio becomes more important when only cash or assets that can be easily turned into cash are used to gauge the protection of short-term creditors. Inventory is removed due to the time and effort required to dispose of the asset, as well as the difficulties in determining the genuine worth of inventory itself. Next is collection period. Accounts receivable turnover is calculated by dividing the annual sales by the accounts receivable balance. A collection period in a day is then calculated by dividing 360 days by the accounts receivable turnover. Another method is divided the accounts receivable by the net sales and multiply the product by 360 days. Either process results in the period of days that the sales are outstanding. The ratio offers indications of the collectivity of receivables and the effectiveness of flow of fund. Next is inventory turnover. Calculation of the ratio is completed by dividing the average inventory into the cost of goods sold and multiplying the result by 360 days. If the cost of goods sold is not available, the net sales should be used even though the results are not quite as accurate. The inventory turnover rate, like receivables, is used to determine the quality of stocks and how quickly they are sold. Industry average should be analyzed to determine normal inventory turnover and whether stocks on the balance sheet are reasonable in relation to sales volume. Next is inventory over working capital. The ratio obtained by dividing average inventories by working capitals is a measurement of adequacy of working capital to support inventories. It is widely acknowledged that the ratio should be less than 100%. If it's close to or greater than 100%, the corporation may be carrying inventory that are far too high to maintain by the company's financial resources. A company with a high inventory to working capital ratio may be overtrading or have excessive, obsolete, or slowing moving inventories on hand, as determined by the depth of capital analysis and others. Next is accounts payable. The accounts payable turnover, calculated by dividing average accounts payable by the purchases, will provide an indication of the paying habits of the company. A high amount of days outstanding indicates that the firm is not discounting and probably paying beyond the net terms. Lastly, short-term loans. By dividing the short-term notes payable by the purchases, a ratio is developed which measures the financing required to back up trade payables for the support of the inventory level. Care should be taken when the figure is excessively in high comparison to industry norms since over the trading and obsolete or slow-moving inventory can spell trouble for the short-term creditor. The previously stated procedures, individually or in combination, should give the credit administrator the quantitative tools needed to issue a credit guide. Other indicators such as the length of time in the business, payments habits, trade reports, and so on will aid in qualifying the customers and determining the amount of risk the credit administrator is willing to take. Regardless of method or methods employed, the credit manager must make a decision of each customer in the file and assign a credit guide. As sales transactions and payment build, the management will begin to notice a trend and will be able to change the credit line accordingly to control the risk.
So for our case analysis, we will discuss the history of Dun & Bradstreet. The corporation presently known as Dun & Bradstreet may be traced back to July 20, 1841 when Louis Tapan created the Mercantile Agency in New York City. In the late 1840s, Tapan transferred the operation of the firm up to Benjamin Douglas, and in 1859, it was incorporated under a new name, R.G. Dun & Firm, when Robert Graham Dun acquired the company. Later in 1931, when it bought the National Credit Office, it restructured under the name R.G. Dun & Corporation. Concurrently, in 1849, John M. Bradstreet created the Bradstreet Company in Cincinnati, Ohio. Bradstreet Company pioneered the use of credit ratings with publishing of the first book of business ratings about 1851. The business moved to New York in 1855 and began publishing its own versions of Dun's renowned title. In February of 1933, Dun & Co. and Bradstreet initiated discussions to merge, and they joined the next month. A note on page 5 of the Wall Street Journal of March 16 gave notice that the firm will now operate under the name R.G. Dun Bradstreet, and in 1939 changed to Dun & Bradstreet Incorporation. They formally changed their name to D&B in 2000 as part of a branding campaign. One of the most widely known characteristics about the brand is their unique DUNS number scheme. This system, the Data Universal Numbering System, was introduced in 1963 and began as a 7-digit number system. According to a May 1963 New York Times story, early firms issued numbers were Union Carbide, Youngstown Sheet and Tube, and Bobby Brooks Incorporated. In 1964 saw the publication of a book containing all of the unique codes. This practice lasted until 1968, and the following year saw the introduction of the numbers into the $1 Million Directory for the first time. The number of locations where the firm is present has increased significantly throughout the years. It continues to provide customers with a diverse selection of items which may be purchased in print and increasingly online. Their print $1 Million Directory was adapted into a web application that was initially known as Selectory and was subsequently rebranded as Relationship Manager. Louise Tapan passed away in the year 1873, but the business that he founded is still in operation today and provides information about other businesses. That would be all for our group report and our case analysis. We hope that you learned something. Thank you very much for listening.